Thanks for joining us today on Market Call. I'm Morella Fernandez. Gordon Reid with us on the show, President and CEO of Goodreid Investment Counsel. He'll take your questions on American equities. Here's how to reach us, 1-855-326-6266. You can email your question to marketcall@bnnbloomberg.ca. Gordon, good to see you. Thanks for coming in.
Thank you, Morel.
We start this new year with a lot of noise again. It seems to ratchet up at the start of the year with Mr. Trump. What is your advice to investors to navigate all of this?
I would leave the political discussions at the dinner table and make sure that they don't infiltrate your investment strategy. And I say that not lightly. It's difficult. But what we have seen over many, many, many decades is that political action is here today and gone tomorrow, and the market tends to see through that. We have seen evidence of that even over the last few days, for example, with the Fed independence issue, and the market, the bond market, the currency markets really isn't taking it all that seriously, and they're letting it just play out. So I think that is a good cue for investors. Stay focused on fundamentals, on what companies are doing, do bottom-up analysis, but don't be unduly swayed by sort of the flavor of the day, the headline of the day. That can be damaging. Okay, let's talk about gold for a moment because it's had quite a run in 2025, continues to break records in the start of this year. Right. Taking up the TSX as well to record highs. What's your take on gold and whether there's more room for it to run? Well, it is related to what we just discussed. Gold is a risk asset and takes a bigger place in portfolios when the markets are a little bit unsure. And it obviously has run a long way. But I would remind people that in the bigger picture, gold has been a lagging asset. I remember back many, many years ago, decades ago, when people were lined up to buy gold when it first hit the $1,000 mark. And interestingly, the Dow Jones wasn't that far off that 1,000 mark at the same time. Not perfectly correlated, but enough to make the point. The point is that gold is up 4.5 times off that level, and the Dow Jones is up almost 50 times off that level. So we have to make sure that we understand the historical significance and that we may be going through a period of time where it is surging, but we have to be careful with that. Okay. As you know, the Prime Minister headed to China, hoping to unwind some of the tariffs that were imposed by that government and looking for new trade partners. Yes. Are you anticipating any change out of that? Will that affect your investing strategy at all? Well, that of course is more of a Canadian issue, and our Canadian manager, Donnie Moss, is very, very aware of what's going on there. And in structuring our portfolios, we of course are sensitive to the fact that some of our industries are heavily affected by tariffs. And we have to look at it from a pricing and valuation standpoint. Again, these things tend not to have long lives. They are incredibly disruptive and certainly very, very disruptive to people even closer than investors, to the employees, to the owners of these companies. But they do come and go. And tariffs tend to be negotiating tactics or measures. And I think that is exactly what these will go down in the history books as. Okay, let's take a quick break. We'll line up the first phone calls for Gordon Reid of Goodreid Investment Counsel. Again, he's taking your questions today on American equities. Here's how to reach us. We're back in just a moment. Welcome back to Market Call. We're going to start with an email from Brenda. She has a question today for Gordon Reid. Would appreciate an analysis of open text. Why has the stock performance been so poor in the last 5 years? And what is the outlook? Is it time to sell? We'll pull up the line chart for open text. They do sort of software sort of portal
infrastructure, I believe, or access. They're at 46.05 or 09 today, and off from a high of late last year.
Yeah.
How well do you know the company?
I don't know it very well. I do know it enough to know that it's in an area that is very much in the news. That is sort of the enterprise software space, and anybody who's followed Oracle or Salesforce knows that or Adobe knows that some of these companies are being priced based on the fear that AI might displace their dominance in their area. And OpenText, I think, is subject to that as well. And in fact, they are reorganizing, and I think there's probably 15 or 20% of their existing revenue that they're trying to unload to redefine who they are in the space and be more AI-centric. Whether that's going to be successful, what comes out of that cloud, we really don't know, and I think that's reflected in the stock price.
Okay, would you hang on? Do you have the same fears about AI eating software firms? Is that something you're staying away from, for example?
I probably wouldn't hang on to OpenText if I was to stay in that sector. I would go more senior. I think that Salesforce is an interesting situation. I'm a little bit fearful of Oracle because of the debt load that they have, and the market is fearful of that as well. And Adobe, I'm fearful that the moat might not be wide enough for that company, because a lot of the work that they have done and the fees that they are able to charge may be supplanted by people like you and me who didn't really know anything about this, just doing it at our fingertips. So Salesforce, I think, is one that's interesting and I'd look at, but I would go more senior.
Okay. Let's go to our first phone call then. Chad is on the line. He's in Saskatoon with a question. Hi, Chad.
Good afternoon, Marilla and Gordon. Gordon, many analysts still rate Amazon as a strong buy, but the stock's been range-bound despite strong fundamentals and cash flow.
Yep.
Would you be a buyer here, and would you scale in using tranches? I'll hang up and listen. Thank you.
Okay, thank you for the question. Amazon sitting at 244 today. I know you've looked at the Mag 7 and sort of how they've compared to the markets in the last year. What did you find? And we'll dig into Amazon after that.
What we found was that surprisingly, only two of the Mag 7, being Google and NVIDIA, outperformed the S&P 500 performance last year. So the other five underperformed, including Amazon, which came in at a very pedestrian 5.2%, I believe, for the year. So it really didn't do much. We are an owner of Amazon. So this is what it takes to be a good investor with portfolios. Sometimes really good companies are just in the shade. They're not getting recognized. You have to distinguish between patience and almost stubbornness, and that's sometimes not that easy. We think that patience with Amazon will yield a very good result. If you think about the company, it's really in three parts: the e-commerce, the cloud, and AI. Their e-commerce network controls 41% of total online sales, so it's a juggernaut. And their AWS cloud offering is also a very, very powerful piece of their business. Controls 30% of the cloud business and is bigger than Microsoft's Azure and also Google's cloud offering. And then finally, their AI offering just sort of ties it all together, and they're certainly in the race there, and that's going to yield good results. So we think some patience here, that it will be a stock that will be recognized over time. And what's happening is that it's becoming cheaper because the price isn't moving, but fundamentally it's doing quite well.
Would you leg in at this point? Was part of that question?
I don't think that, well, it depends. Without having seen the caller's portfolio and the structure and so on, I don't want to get too far out over my skis. We tend not to leg in. If we like a position, we take a fairly meaningful stake in the position in the stock. But it is a strategy that you can use. I know many people do. It's just not one that Goodreid uses predominantly.
Okay. Let's move on to our next caller then. JP is in Edmonton, and he has a question today. Hi, JP.
Hi, guys. Thanks for taking my call. Happy New Year to you, Gordon.
Thank you.
So I called last year and took your advice on buying Elevance, and then it dipped, and I waited for you to come back on and took your advice again on staying patient and not panicking, which paid off because now it's had a good run up this year so far. So I'm hoping to go 3 for 3 with you and get your thoughts on where it could go and what's a good forecast for it this year, whether I should hang on or wait for a certain amount and dip out. So I'll hang up and hear your call. Thanks for that.
Sure.
Thank you for the question. They operate as a health insurance company. They're at 370 today. Dipped off last summer and had a comeback. Is this something you still like, still hold on to?
Yes, we continue to own Elevance. It has been a problem industry without question. It's been upset by their margins, which are medical cost ratios, and it's really a function of how the behavior of their insured population has changed, and COVID had a lot to do with it. Of course, when COVID hit, people stopped procedures. They stopped claiming insurance or medical costs against their insurance because they weren't going out. And then, of course, after we got over the hump in terms of COVID, everybody did the same time at the same.
Came back to get everything done, yes.
So there was a lot of pressure on the profitability of these companies. And then you had to look at the government funding for the commercial side, and it tends to lag. So this whole industry has been sort of up and down, and the results have been lumpy because the timing has been lumpy. I think coming into 2026, there's certainly going to be a big bump in terms of the premiums that Elevance is getting off procedures. It's a matter of how they manage that, and it's more of an industry issue than an individual company issue. I would say on the company issue side that Elevance isn't quite as exposed as some of the other insurers, simply because they have many of their policies have spread the risk. So the employer takes on part of the risk to achieve lower premiums for their employees. So that can work in Elevance's case. So I would say to JP, we are hanging on. We think that there's good value ahead, and we'll see where it goes.
Okay, let's take another break. We will be back with Gordon Reid of Goodreid Investment Counsel. Again, he's taking your questions today on American Equities. We're back in just a moment. Stay tuned. Welcome back to Market Call. Sam's on the line. He's in Ottawa, and he's got a question today for Gordon Reid. Hi, Sam.
Hello, good afternoon, Mr. Reid. Just wondering regarding J.P. Morgan and your thoughts regarding the earnings today, as well as Trump threatening 10% cap on interest rate. I mean, it's only for 1 year and it has to be approved. So, if you could please share some thoughts, I would really appreciate it. Thank you and have a good day.
Okay, thank you for the question. J.P. Morgan did report today there was some weakness in some of their guidance for underwriting. But what is your take when you step back and look at J.P. Morgan?
Yeah, we're an owner of J.P. Morgan along with a number of the other money center banks, and like them very much. J.P. Morgan is priced a little higher. The valuation is a little more stretched than some of the others, in response to the fact that it's just a premium bank and deserving of that valuation, in our opinion. They were a little light on the investment bank side. That can be lumpy. You've got to close deals to book the revenue, and sometimes there's some timing issues. Otherwise, it was a very good report. They actually upped their interest income estimate from $92 billion to $95 billion for 2026, and they beat both on the revenue and the earnings side. So we were quite happy with the report. But as often happens, people sell the news, and it's a one-day event. I think longer term, there's great promise for the banking sector in 2026. That's an overweighted Goodreid, and JP Morgan is a part of that.
Okay. Let's move on to another caller then. Jack's on the line in Toronto with a question. Hi, Jack.
Hi, Marilla. Hi, Gordon. Happy New Year.
You too.
I was wondering about, it's been on my radar, Pfizer. What do you think about it? Do you think it's a good entry point now, or what do you think is a good entry point? Thanks very much. Bye.
Okay, thank you for the question. Pfizer's at 25.08. What's your take on pharma, Pfizer, and specifically, what does it have in the pipe for?
Yeah, that's the question, and you know, my answer to Jack is quite bluntly, I guess, I wouldn't buy Pfizer at this point. I think there are many other opportunities in the space, whether it's pure pharma or biopharma. Pfizer is really spinning its wheels. There's not a lot in the pipeline. If you look out even 4 or 5 years past the end of the decade, there's really not a lot of hope on the sell side for a big move in revenues and earnings. So any gains that they make are going to be coming off cost cutting and perhaps a tuck-in acquisition or two. We think that there's other opportunities. I'll give you a couple of names. Merck on the purely competitive side to Pfizer, a great pipeline, and now they've got to overcome the patent cliff of Keytruda and Gardasil. That is certainly true, but they've got dozens of companies or drug compounds rather in the phase 2 and phase 3 area that are very promising. On the biotech side, I'd throw at Amgen, and I think it's well priced, and again, they had 15 compounds that are approved that did double-digit sales growth increases last quarter. So lots of opportunities there. So I would avoid Pfizer in favor of something else, and I've thrown out a couple.
Okay. That was for Jack. Let's go to Billy. He's in Mississauga, Ontario with a question. Hi, Billy.
Hi there. Thanks for taking my call. Wow, what a year, especially for financials. Yeah. Gordon, I'm trying to diversify a little bit towards some future trends, and I kind of a little reticent, not quite ready to jump into something like copper. They're a price taker, and I'm just not crazy about that direction. But I wanted your thoughts on Eaton Corp. I'm okay with the medium long-term hold, and I'm just wondering mostly about the current price. I'd like your thoughts on that. Thank you very much.
Okay, thank you for the question. Tell me a little bit more about Eaton Corp. So they're a power operator, essentially.
Right. So the division that really is driving the success at Eaton is their electrical division as it relates to data center development.
Okay.
And the stock has done very, very well. The company has done very, very well. We owned it back a couple of years ago. Excuse me, a couple of years ago, and sold it on valuation. Got into the 32, 33 time earnings level or area, and we thought that was a little bit rich. The whole space has come off a little bit. As you know, there's some question out there about all of these commitments, these dollars, these hundreds of billions of dollars that are being
overspent
committed.
Is there, yes.
And everything's being affected, including the suppliers to these data centers. So are they going to happen? And we're looking at companies like Eaton. It's come off from the 380s down to I think 320, 330 here. It's also come off in terms of its valuation range. It's trading right now in the high 20s, which is somewhat attractive to us. But it's about the entry point, and I think, Billy, you have to be aware that you might get in and your first move might be down because this trend is still there. You mentioned medium to long term, and I think that says a lot. I think longer term, there is good opportunity here, and this is a range that you certainly could make an investment in. But again, is 330 going to become 310 or 300? Perhaps, but longer term, I think there's a good reward to be had.
Okay, let's get to an email then. This is from Troy in Southeast Saskatchewan. He says, looking to see Gordon's outlook for 2026 on Uber. So Uber, I realize, has a lot of partnerships in trying to go with a driverless cab situation that everybody's looking forward to, more rolled out in the U.S. and here. I believe you have invested in Uber a while back.
Yes, yeah, we've been
held it.
Yeah, we've been an owner of Uber for some time, and you know, our approach to this is that there's always competition to good ideas, and good companies use that competition to make themselves better and adapt. And that's exactly what Uber is doing. So they've got many alliances and areas that they're working with other companies, whether it's Waymo or any other self-driving operation. And we think the future is going to be one where there is a very large addressable market, much larger than the addressable market of ride-hailing, ride-sharing programs today. And what piece of that Uber owns is a question. It could own a lower percentage of a much larger opportunity. And people who have watched me in the past know that I've talked in these terms when it came to Google and search and how AI was going to affect search. It's the bigger pie story, and it's certainly working out extremely well for Google. I think it's going to work out very, very well for Uber. This is going to be a ubiquitous opportunity, like a situation that we're moving away from driving our own cars. It's just a matter of time.
Moving to nobody driving the car.
Right, and the costs and the whole financial framework is going to be very interesting and very, very attractive. So you look at the cost of a mile or a kilometer with Uber with a driver, it's half the cost if you have a driverless situation.
Interesting. Okay.
And you've got a 24/7 opportunity. There's nobody to get tired.
That is true too. Okay, let's take a quick break. We are going to have a look at Gordon's past picks when we come back. Time now to have a look at past picks from Gordon Reid, January 9th of 2025, so a year ago. At the time, you picked Goldman Sachs on the New York Stock Exchange. It was 580.02 US at the time, now to an incredible 936.17, 61% upside, 64% total return. What has been going so right for Goldman Sachs?
Well, a lot of things, as you might expect. The whole group did extremely well in 2025, but Goldman was one of the leaders. And it's a leader because it is one of the most senior franchises in the banking system. And it's not really a pure money center bank, of course, is it? It's more of an investment bank. In fact, about 65% of their revenues come from investment banking.
Okay.
And 2025 was a very good year. But,
across the board in that space, yes.
But you know, it's not being talked about as an outstanding year. It was just a very good year. It kind of did what people were expecting it to do. So, you know, IPO business, takeovers, capital raises, you know, that type of thing, very, very active. But 2026 is seen as a year that should be as good or better. And J.P. Morgan, in fact, talked about it this morning, saying the pipeline was just full. And I think Goldman reports on Thursday, and I think they're going to be talking about that as well. So we think there's a lot of runway here for Goldman, even though it had a very good 2025.
Deregulation part of that?
Yes,
Goldman?
yeah.
Okay.
That's a piece of it as well. So everything's lined up for increased profitability.
Okay, let's get to your next past pick, Merck on the New York Stock Exchange. You touched on a little bit earlier, a 99.85 at the time, US. and now to 107.47, so 8% upside, 11% total return. A harder space in 2025, but you still obviously like Merck. You've recommended it.
Yes.
Why do you like Merck over some of the others in that same space?
Well, I mentioned the pipeline earlier, and they've got many compounds that they've developed internally that will move to abate some of the displacement that they're going to have with Keytruda, which is their really big oncology franchise, and they've also got Gardasil, which is an RSV medicine, and every drug company faces this, the patent cliff, where revenues and earnings start to drop off because they no longer have exclusivity, and it has to be replaced. And Merck's done a great job internally, but they've also done a good job by buying companies and tucking them in. So they've got a really full opportunity, and that's exciting. You look at the chart, you can see that the whole year wasn't that great. The middle part of the year, they dipped down. There wasn't a lot of interest in healthcare. But of course, what happened late in the year was that the bloom came off the rose on technology, on communication services. And a lot of that investment money, those dollars, look for a new home. And there was good value in the healthcare space. It started to get a bid finally after a very long time.
Okay, let's get to your third pick then. Pulte Group, PHM on the New York Stock Exchange at 110.46 US last January, now to 132.78, so 20% upside, a total return of 21%, and they do housing construction.
Yes.
Is that something you're looking to gain from this year? Housing has also been pretty tight over the last year.
It has, and on a fundamental basis, if you look at revenues and earnings growth and revisions, there's not a lot of hope. I mean, you look at it, there's not a lot there. But what is there is the fact that there's a huge undersupply of homes in the United States. President Trump mentioned it last week and said, we've got to loosen this up. And he talked about restricting institutional investors from buying single-family homes and renting them. What he's trying to do, and whether that's the right move or not, is another question. But what he's trying to do is invigorate the home building space so that people can get into homes. So there's lots of people who want to move into homes, but there's not the supply because home builders are restricted by governmental regulation. It's often state and municipally driven. You can't develop land without a huge cost. So that's the opportunity. And these home builders, and we own a number of them in our small cap portfolio at Goodreid, are primed to do well if they can create some space to supply the market with what they need, which is probably another 2 or 3 million homes.
Okay, let's leave it there for this block. We are going to take a break. We're back in a moment with more of your phone calls and questions. Stay tuned. Welcome back to Market Call. John's on the line. He's got a question. He's in London, Ontario today. Hi, John.
Hello, Gordon. Gordon, Mr. Trump wants to cap interest rates on credit cards at 10% come January 20th. Assuming that happens, and I wouldn't bet against him, wouldn't Visa's revenue actually go up? Because wouldn't the run-of-the-mill Visa user just use more transactions on their Visa card? Because now the interest rates they face is 10% instead of 19%. Trump thinks he's going to save $100 billion that can be used to invest in and buy goods. What's your financial thought on that? Thanks very much.
Okay, I'm going to add a piece to that because what we've heard from some of the lenders is that people will lose their credit cards because the risk is too high.
Yes.
The 20% offsets that risk. So if you could weigh in on both factors for me.
Yeah. I mean, John has sort of correct assumptions on one side of the equation.
People will spend more.
Yes, but there's another side of the equation, and that is that maybe you'd say there's something worse than having a high rate credit card, and that is no credit, because the lending institutions who are issuing those credit cards say you don't qualify now for the credit card because at 10% we can't take the chance with you. A lot of these, this is unsecured debt, and the write-offs are large. By some estimates, up to 5% of credit card debt is written off. So they're priced the way they're priced because risk markets say this is how it all sort of works and is in equilibrium. I would say to President Trump, go back to 2008 and start to look at what happens when you start playing around with financial markets. And I'd look back then at the housing market when people could own a home with fictitious income and so on and so forth. Look what happens when that happens. And I would very much doubt that this happens in the short term. My guess is it gets kicked down, the can gets kicked down the road and ultimately dies on the vine. It would be destructive to the financial markets for something like this to be put in place. And it would be hurtful for everybody, including the owners of the
credit
debt.
Cards.
Yeah.
Okay. Love to talk some more about this, but I want to get some more callers in. So let's go to Rob in Montreal.
Yeah.
Hi, Rob.
Hi, Morella. Hi, Gordon. Netflix, do you think it will hit $300 in 6 years from now? Thank you.
I love the well, do you think it'll hit this by this time? Okay, yeah. Netflix, also a lot to talk about because of the look. They're trying to get Warner Brothers. They've got Paramount pushing hard to try and get in on the deal, which is sinking obviously the Netflix shares here. It's at $89.70 today.
Right.
What do you see for Netflix?
Well, I don't think it would be all that great if Netflix did get the Warner Brothers deal. It's a very unpopular deal in Hollywood. It's going to take Netflix's eye off the ball. I don't see the value, to be honest with you, in Warner Brothers that the market is seeing. So there's a lot of reasons that I kind of think if I'm a Netflix holder, I don't want this deal to be successful. So I would stay away from Netflix here. It's not an inexpensive stock to begin with. They do, on the positive side, they've kind of won the streaming wars and do a great job with that. But I think a lot of that is built into the price, and given the landscape that we're looking at, I would avoid.
Okay. Let's move on then to Todd, who's in Niagara Falls, Ontario, with a question. Hi, Todd.
Hi there. Thanks for taking my call. My call is regarding silver. I'd like to get, opinion on the silver and gold.
Okay.
What do you?
You're cutting out a little bit. So from what I got, silver and gold both have been running up. We had record highs even yesterday in both of the metals. Would you still invest at the levels they are at today for both gold and silver? Well,
we talked a little bit about gold earlier in the show. Silver is a little trickier. Even though it has some industrial use, its price is also heavily affected by the financial markets. So at the end of the year, we saw a lot of volatility in silver prices. It had a great deal to do with the exchanges and margin rates and changing margin on silver holdings, so how much you could borrow against existing holdings. And this is something that gets very, very tricky, and I don't think really belongs in most people's portfolio. It's just a little bit above most pay grades. It's for the professionals. So I would avoid the silver trade if you're in this area as a risk-on.
Sort of a precious metals.
Yeah, a risk-on trade. Gold, we talked about a little bit earlier. In our Canadian portfolio, our Canadian manager, Donnie Moss, owns Agnico Eagle, which we quite like. It's, we think, the premier producer in Canada. It's obviously got political stability, which a lot of precious metals or even mining companies around the world don't have, and people don't consider that when they make the investments. Where is the jurisdiction? Venezuela certainly taught us about that. So, Agnico Eagle, homegrown, a good producer, high operating leverage. They produce for something like $900 an ounce, and we know that the stock or the commodity price is
well above that.
4,600
an
ounce. So highly profitable, and they do 3.3 million ounces, I think, something like that. So very good producer, and we
that's
think
the way you'd go.
We'd go with that with a miner.
Okay, let's take a quick break then. Gordon Reid taking your questions today. We're back in just a moment. Welcome back. Ghulam's on the line in Toronto with a question today, so let's go there. Ghulam, what's your question?
Hi, my question is on GE, General Electric. I hold the three companies in that umbrella. I'm just wondering, and it's done pretty well so far. I'm wondering whether I should hold on to it for further upside, or is it time to sell and take a profit? I'd appreciate your opinion. Thank you.
Thank you for the question. GE itself seen as more of an aerospace company.
Yes.
What more do we know about the others and sort of the trend for all?
Right. Well, GE, of course, had its troubles and came out of that very poor period, splitting the company into three. You mentioned, Morella, the aerospace piece, which was the core GE space, and then they split out their healthcare operations, and also split out a company called Verona, which is their power piece. And the Verona has done incredibly well over time. Maybe there's a longer chart there. I think it's done very, very well.
Okay.
But
how long ago were they spun it out?
Probably 3-4 years ago.
Okay.
I'm guessing, but something like that. So they've done extremely well, and the Verona part of it really is tied to the data center expansion and this whole theme, and has done well on that basis. And you can see the aerospace piece here also has done very, very well. On my top picks, I'm going to talk about another aerospace company that ties right into this, and then the GE Healthcare also has done well, but not as well, and has some opportunities, but also some headwinds. They're the company, if you go in for imaging, you'll see a GE MRI and that type of thing. And the opportunity here is AI, and AI can make this type of equipment much more efficient and much more relevant in the healthcare space. So the caller was asking, would I keep GE?
Would you hold all three? Yes.
Well, that's too broad, I think, a question. You have to look at each of the three individually and also at your portfolio. I think that each of them have some virtues. The problem that I have with the Verona is it's extremely expensive. It's done very, very well, but it's being priced for long-term, very long-term success. So I'd probably pass on that. The other two I would probably keep. One, the aerospace, I like that space, and there's great opportunity in the healthcare. I think it's well priced.
All right, that was for GE. For Ghulam, let's get to one more caller. John's on the line in Red Deer, Alberta. Hi, John.
Hi there. My question's in regards to ExxonMobil, ticker symbol XOM. What's Gordon's thoughts in regards to the energy sector and perhaps specifically with Exxon?
Yeah.
And
okay, we may have trailed off on that phone call, but ExxonMobil, a lot of the the energy stocks, the oil stocks, right? Pretty beaten down.
Yes.
Over the last year, the price of oil has not done well. There are concerns about oversupply. Would you invest in something like Exxon at this point?
Not at this point. And I think it's not a discussion about Exxon. It's more a discussion, as you were referencing, about oil and where oil fits in from a supply-demand standpoint. We are well supplied in oil and petro products, and that's reflected in the oil price. The idea of peak oil, is sort of faded a little bit, been pushed off. But the fact is that technology and access to new reserves has allowed the supply just to surge. And for a couple of generations, we've seen OPEC, for example, really manage the supply to try to affect the price. So I would be quite reluctant until I started to see a reason for oil prices to rise before I got involved.
Or you dip back in. Okay, let's take a quick break. New topics from Gordon when we come back. Join us tomorrow on Market Call. Bruce Campbell will be with us on the show. He's president and portfolio manager at Stone Castle Investment Management. He'll take your questions on Canadian stock picks. That's tomorrow. Let's get new top picks today from Gordon, and we're going to start with Meta on the NASDAQ. Meta, of course, very well-known name, pulling back from metaverse spending to redeploy funds probably into AI. Yeah. What do you like about Meta moving forward?
I think the thing you have to start with when you talk about Meta is the fact that 1 in 2 human beings every single day uses one of their products, whether it's Instagram or WhatsApp or Facebook. And that's just incredible reach. And Mark Zuckerberg has built a juggernaut. Follow that with the fact that it's trading historically against its own history and against the market very attractively at 21 times earnings. It's traded about 15% off its highs, and that's come because of thoughts that maybe they aren't as dominant in the AI race, and that's probably true. But it's a race, and Mark Zuckerberg is incredibly competitive, and he will use incredible resources to win. And their Llama product is certainly a good product, and he will be a part of that AI race.
This sounds like a bet more on the leader than it is necessarily on some of the other components of what they own, or is it both?
I think that's fair.
Yep.
I think that's fair. He is a very good leader. He's just hired a new president who is very well tied to the financial markets, the capital markets, and that's Powell McCormick. Okay. She has a long history with Goldman Sachs, is very well connected to sources of capital around the world, and that's important to Zuckerberg, I think.
Okay.
So we very much like Meta. It's trading about 15% off its highs. We think this is a good entry point.
All right, let's get to your next pick, which is Morgan Stanley on the New York Stock Exchange. I know you go heavy on financials. Morgan Stanley, moving forward, we talked about some of the benefits of financials in the U.S. this year.
Yes. $5 trillion assets under administration. Or under management. They have put together through tuck-ins a very good wealth management business. They've purchased E-Trade. They purchased Eaton Vance. Of course, years and years ago, a couple of decades ago, they purchased Smith Barney. So they've got a nice wealth management business that makes up about 50% of their total business. They trade at about 17 times earnings. They have a 17% return on equity. 23% return on tangible common equity. So they're doing a good job with what they've got. And they're positioned along with the JP Morgans of the world that I talked about earlier in the show and Goldman, positioned to do well. The backdrop is very, very favorable for companies like Morgan Stanley. So we think that they're a good pick.
Okay, let's get to your third pick, RTX Core on the New York Stock Exchange, aerospace, defense.
Yes.
This is a bet, I guess, on up to military spending that is already happening in the U.S. and the leadership push to get even more.
Partially, but they're both a commercial aerospace company and a defense contractor. In fact, about 66% of their total revenues comes from the commercial side. So they own Goodrich and Collins and Pratt and Whitney and do servicing on many of the jets that we fly around in every day. So that's a great business and a growing business. It's very important to airlines to have new equipment because new equipment is fuel efficient. And that fuel efficiency, which might be quantified as something like 7 to 10% of costs, is their profit margin. So flying a new airplane can be profitable. Flying the same route with an older airplane, maybe not so much profitable. So that's the aerospace side, the commercial side. The defense side, we heard just the other day that Trump was talking about a $1.5 trillion defense budget, which is a multiple of where it is today. NATO is spending a lot more money on defense. The world geopolitically is more unstable. So products like the Patriot missile are going to be in need, and RTX produces those. So heavy on the revenue growth and the cash flow side.
All right. We'll leave it at there. Gordon Reid, thanks for coming in and good to see you.
Thank you. Good to see you too.
And thank you for joining us today on Market Call. We'll see you back here tomorrow.